the activity number 2 also we did, no? Yesterday. So we have to do activity number 3. You can start recording. Okay. There is one small new thing I will explain about this. Purchase consideration. From yesterday's understanding, what we know is purchase consideration is the money that we are paying to acquire the shares of the subsidiary. Let's say company A acquiring company B. Company A acquiring, let's say 1 million shares. Now, the meaning of purchase consideration that simply we understand the amount of money that we are paying to buy this. So the understanding that we need to make is mode of payments. There is how you are going to settle. There are 3 methods. One, immediate cash. That's what we discussed even yesterday. At the time of acquiring the company, you are paying cash. 2, deferred payments. Meaning, let's say I purchased on 1 January 2020. I agree that I will pay on 1 January 2022 after 2 years. So it's like a loan. You agree that you will pay in 2 years time. So this is the second scenario. Third method is contingent payment. Meaning you purchase the subsidiary. You make an agreement with the subsidiary shareholders before you buy, the owners of the company. They negotiate. They say that this year company will generate 2 million profits. Or this year 2 million, next year 2.1, in the third year 2.2, like that. And if this company reaches to these profits, you should pay us something extra. So that is what we call contingent payment. We call it conditional payments. And number 4, share exchange. I buy the share. See here we are purchasing 1 million shares. I issue 300,000 shares of my company, and I give that shares to the shareholders of the outgoing shareholders of the subsidiary. So these 4 methods available. So we need to understand the double entry for these 4 methods. First one, accounting entry. First method, debit, investment, credit, cash. Simple.
This is on whose book actually?
In the investor, in the parent company's books. Nothing in the subsidiary books.
cash is going out and then investment.
Then you remember, when I calculate goodwill, I have taken this amount. So that is the next stage. We don't need to worry about that. Second one, deferred. Now, deferred consideration, there is a small complication comes in, something called, when I write, time value of money comes in. This concept is coming in. What do you mean by time value of money? Year 0, year 1, year 2. You are going to pay here 1 million. But this 1 million in today's term, is it 1 million? You are going to receive 1 million cash after 2 years. And then that 1 million you are going to receive after 2 years. Is it the same as of now? Value is big or less?
Yes.
Less. So there is something called discounting.
Is it like inflation?
Exactly. Because of the inflation, the money value will go down if you work out the today's terms. We need to work out the today's terms. So we should discount it to today's term. Then we need to pass the double entry. Debit, investment, credit. Have we paid the cash today? No, pay. Now let's say 1 million, today's term, just for the sake of example, 820. Now if it is only 1 year, this will become the 0, no? Then what do you think? The amount reduction is same like this or bigger than this?
Little bit bigger than
Little bigger than this, no? Let's say 935. Okay? So now, investment 800 and how much? 20, no? Payable 820. See, this is today. And this no problem. I will transfer this to calculate the goodwill. It is coming from payable. This will be carried forward as it is. No issues. But end of the first year, how much payable it will be? 935. So there is a difference coming in, right? How much is the difference? 1 Right. This you have to transfer to P&L as a finance cost. So now you go to the next year.
So in
Go
this,
for
in this situation, sir, the investment will be 820 only.
that will not change. That will remain 820 only. But the payable only will change. Investment at the year 0 is done. And we calculate goodwill and the story over. But this payable will continue. So here 935. But end of the second year, cash. How much I will pay? I will pay 1 million.
And again,
So,
another finance cost.
65, this also P&L. Finance. Clear? So this is the how you deal when you happen to have deferred consideration. Third one. Concept is different, accounting treatment is same. What is the concept? Only when if you satisfy a condition, then you pay extra. So you are not going to pay now. you will pay after 1 year or 2 years or 3 years. So the same calculation will come. Same as method 2. Method 4. Share exchange. Now let's say company A and company B. For every 2 shares of company B, company A gives 1 share. When company A receiving 2 shares, company A giving 1 share. You receive 2, you issue 1. Now you are purchasing 400,000 shares of company B. So how many shares of company A you will issue?
201.
You divide that by 200,000 you will issue. Now, how to find out the double entries? Then you need to know the share price of company A. Let's say par value is $1. You are issuing at 1.5. So that means 0.5 is what? Premium. So how many shares we are issuing? 200,000 shares. So 200,000 into 1.5. How much is that? So investment will be how much?
200.
No, investment is 300,000. Your total investment to buy the company B 400,000 shares, your total value is 300,000. So double entry, you debit investment 300,000. You credit share capital how much? 200 exactly. 200,000. And then you credit share premium. Clear? So now we will go to the question. Now you should be able to answer the question easily.
Which number?
Page number
433.
follow that.
Yesterday we stopped here.
Yeah, we did activity 2.
Yes.
Activity?
This is not finished yesterday.
You finished?
No, until this one, last one.
Yeah.
52.
Correct.
Okay, what about this one?
Is it done with this question we did?
No.
1 minute. So. Didn't we do this question?
Done.
Okay, one.
This question done, no?
Done.
Okay. And then what about this question?
Did.
We did. And then what, which page number you are referring?
411.
400? One. We did this, right? This example we did, correct?
Yeah, yes.
Then we did this also, correct?
Yes. This no.
This question I didn't do. I think I did.
No, done. 1,300.
We did.
Yes, 5,200, 4,000 is the this one.
Ah.
Pre-request profit.
Yes, this we did.
If you check the workings, you will find it.
The PDF file,
Yeah, PDF.
group message. The group message PDF file there. Answers.
the activity last?
Activity 2.
This is chapter 24, activity 1,
Page 427.
27. So before
அதுக்கு அடுத்த ஒன்று செஞ்சுக்கிறேன் பாருங்க.
activity 3, page 411. So look at it.
That one finish.
அதுக்கு செய்தா
இல்ல கடைசியா செஞ்ச எத்தனாவது இது பாருங்க. அப்ப எங்களுக்கு அதை மட்டும் நாங்க செஞ்சுக்கிறோம்.
இப்போ இந்த பர்சன்டேஜ் தானே திஸ் கொஸ்டின் ஓகேவா
This is 24.
தென் சாப்டர் 24 ஆஃப்டர்
427.
சரியா அது மிஸ் ஆகுதா இடையில
அது activity 1.
சரி ஓகே discussion.
411 will finish.
Discussion.
After that 400.
Today, yeah? This one also finished? This one, okay. 53 not finished. This today, yeah?
This one we are doing today. Okay, we need to do this. Can you please? Here they are only asking you to work out the goodwill. So you just need to do the working one and working two. So can you draw the group structure, please? There is another new point here. The fair value. I will give idea for that also. Now we learn in property, plant and equipment how to do the revaluation. And here they say, let's say now they are purchasing this room, and this table, assume is a very important table. So normal cost of this table is 1,000 there. So the seller saying, if you want to buy this business, this table I will charge you 2,000 there. Normal net book value is how much? 1,000. But he is asking how much? 2,000. So there is extra 1,000. That 1,000 also should be considered as a net asset for the purpose of calculating. So net asset is equity. Equity means share capital and reserve. So in that reserve list, you will write this out. That's it. At the time of acquisition, any revaluation should be treated as part of equity or now you can write. Activity number
3.
Page number
430.
130.
3.
Working 1. What company is that?
X, Y, and Y.
X and Y. They are purchasing 300,000 shares of 400,000 shares. So what is the percentage? Investment. Cash how much? 250,000 cash. Shares. What they say about the shares?
New shares, it's on 143 basis.
1 for 3. So, how many? So 1 is to 3. That means we are purchasing 300,000 shares into 1 over 3. How many shares then? 100,000. So 100,000 into what is the market price?
1.35.
The quoted price of the shares, X shares of the acquisition rate was 7.3. That is leave it. We don't need to worry about that now. We need the price of the parent company. Yeah, it's a parent, X is parent, no?
Yeah.
Yes, 7 point.
So have you arrived at 300,000, 1 into 3 correct?
See, you see here.
Says over there.
Can you read the question, please?
So 300,000 shares.
You are buying. X is buying 300,000 shares from Y.
So Y
Total
company
shares
has
400,000.
400,000 shares.
Total. Y company total shares 400,000. X is purchasing 300,000.
Which is
So,
75%.
in buying 300,000, the arrangement is every 3 shares you receive, you will give 1 share. So, this is the arrangement.
Yeah.
Yeah.
This guy.
You done?
Other side also.
Don't know, let's see. Okay? May be correct, but let's see. So, 100,000 into
7.35.
7.35.
35.
Yes. So, this share capital how much? Share premium how much?
100,000 shares. Share capital.
Share premium 600.
35.
So now total investment then 250 plus
150 plus 735.
so that is 700, 900, 950, 985,000. Correct? Now calculation. Okay, here retain earning how much? At the time of acquisition, how much is the return earning?
500,000.
500,000. The fair value change, that is between the
60,000.
60,000. This is 160 minus
100.
NCI. How much is NCI?
280.
280. Without, huh?
From where 160 minus 100?
I'll show you. Is the fair value, book value is 100. So the fair value difference is the
60.
now calculation
This
of
all in first step, huh?
yeah first working.
Okay.
Working to calculation of goodwill. Purchase 985. NCI 280, correct? 280, no? So, okay, what is the total?
1,265,265.
265 minus fair value of identifiable net assets of subsidiary at the date of share capital of the subsidiary. How much?
400,000.
400,000. And then return earning,
500,000.
fair value,
60.
960. How much is goodwill?
305.
Hmm?
305.
Is the difference 305? Now 1265 minus 960. Are this understood or not? Velangal. You understood this calculation workings or not?
Up to that one.
I'll go again one by one. Okay. Company X is purchasing company Y. What is the total number of shares of company Y? 100,000. Company X is buying how many shares? 300,000. So we know that 70. Actually, this calculation not important. Return earning at the date of acquisition, you have to find out. That is 500. Fair value, that what is this fair value? Among the net asset, among your property, there is one particular property that there was a negotiation to increase the value by 60,000. The net book value was 100. They said that no, we cannot give you at 100, we have to charge you 160. So, that is this. And then, the non-controlling interest, the value of the shares for the other shareholders, 25%, correct. So that is 280. That clear? And then we have to find out the investment. Investment two types. Cash, 250,000. Straightforward, no problem. Second, share exchange. Every 3 shares you receive, you give 1 share. So 300,000 shares I am receiving. So I will have to give 100,000 shares. What is the share price of 1 share? 7.35. So 7.35 into 100,000. That is 735,000. On the other hand, if you see the question, the par value of the share is $1. So 1 into 100,000 is my share capital. Difference between this and this will become share premium. So the total investment is 985. Clear? Yes, sir, clear? Then we have to do the normal, the same format of to calculate the goodwill. So purchase consideration, in CA we take the total and then we find out the net asset and then make the difference. Clear? You okay, Mr. Down? And yes, sir, okay? Okay, let's go to the next question. Okay. Next small complication coming. Intercompany trading. It's interesting.